In this week's video, we'll show why it's fair to say that stocks held at key levels last week and why the odds still favor bullish outcomes. This is the title slide from last week's video, Bulls Still in Control, but correction odds are increasing. We said that the key was tech, credit spreads, small caps, and financials. Intra-week, all of these charts looked very vulnerable. The stock market was down over 1% in the middle of the week and then rallied off of the lows and had an intraday reversal on Thursday and finished positive for the week. These, we said, were key. QQQs were up last week. These are weekly figures. Credit spreads improved last week. Small caps up for the week. Financials up for the week. These bullet points are what we'll cover in this week's video. We'll look at the long-term breakout on a monthly chart. We'll look at trends from daily, weekly, and a monthly perspective. We'll review the CCM Big Four charts. We'll talk about why making decisions intra-week can be dangerous relative to waiting for the close on Friday when you're using weekly charts. We'll review the VIX, Fibonacci retracements, how the 50-day moving averages came into play on several charts. We'll look at hedging activity versus bullish buying activity, and we'll look at the weekly chart of small caps. As always, it's important that we maintain maximum flexibility and keep an open mind and pay attention to what is happening rather than what has happened or what we would like to have happen. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Just a reminder that the tapering talk from the Fed is not going away anytime soon. The next meeting takes place on June 18th and June 19th. This is the long-term monthly chart of the S&P 500 that we've shown in these videos before. It goes back roughly to 1999, 2000 area. For resistance here, we've noted in the past that this was a bullish breakout. We also noted that it's always possible to retest your breakouts. It appears, and keep in mind this line was drawn weeks ago, if not months ago. It appears as if we've come back and had a successful retest. As long as the low of this month, which is 1598, as long as that low holds, this is a bullish breakout for stocks. This is another bullish breakout we've shown in the past. This is the weekly NYUD or NYSC advancing volume minus declining volume. This breakout dates back to 2007, and it is also holding in a bullish manner. The next three charts will show you moving averages that we use in the CCM models to track long, intermediate term, and short term trends in numerous markets. These MAs or moving averages range from the 20-day exponential moving average all the way up to the 580-day moving average. And for the most part, we look at slopes. The purpose of showing this: positive slope, bullish, positive slope, bullish, bullish, bullish. Even the shorter term MAs looked vulnerable here, and in the last two trading days of the week have turned back up. What this tells us is the benefit of the doubt goes to the bulls, and without question, the trend is up. It's difficult to short in this environment for any length of time. If you're a swing trader and you short more in a day trading fashion, that's quite different from what investors would do. But for an investor to go short in this environment, until something changes, the odds are against them. Same concepts. These are moving averages that we use in the various CCM models to track trends. In this case, on a weekly chart, they vary from the 3-week exponential moving average in green all the way up to the 40-week simple moving average in red. See, in every case, as of the close on Friday, June 7th, slope is up, positive slope, green over pink, which is the shorter term moving average above the longer term moving average, pink. Similar to the chart we just looked at, the bias from an intermediate term perspective or weekly perspective remains bullish. When would that bias change? Here, when the moving averages roll over and the slopes turn down and you get a bearish moving average crossover here. Here we held bullish. Some consolidation, but we held bullish. Here we appear to be consolidating again until this morphs into something like this. The odds favor higher highs in stocks. Now we're looking at trends from a very long-term perspective, same concept. These are moving averages used in the CCM models on a monthly basis. They range from the 3-month exponential moving average all the way out to the 15-month exponential moving average. The 3 previous charts, there's nothing magical about any of the moving averages that we've picked. You can use any number of moving averages and combinations. The most important thing is that you have a system and a way to track those moving averages and rules and hard and fast ways to make decisions and to track it. Numerous things work in the stock market. The important thing is that you have a way to implement off of moving averages or anything that you use. We'll shift gears now to the CCM Big Four charts we use in one of the CCM models. This is the S&P 500 weekly. Got a blue and a red exponential moving average. This is what bullish conditions look like. This is what bearish conditions look like. As of the close on June 7th, things looked a little dicey intra-week. We ended up closing this week on the S&P 500 with a gain of over 12 points. Shows the importance of looking at monthly and weekly charts on a closing basis in terms of how you emphasize them. A weekly chart at 4 p.m. on Friday is infinitely more important than a weekly chart at 9:30 a.m. on Thursday when things did not look good this week. We closed this week. This still has a bullish look to it. As long as this remains, we'll err on the bullish side of the spectrum. This is the second weekly chart in the CCM Big Four charts. This is longs versus shorts. Similar concepts. This is what an ugly period looks like, or risk off. You can see when the ratio looks like this, bad things tend to happen in the weekly S&P 500. And when the ratio and the moving averages have this look, good things tend to happen in the stock market. Bearish trend, bullish trend. As of the close on Friday, this still has a bullish look on all of these charts. We would feel better if we can make a higher high. This is chart 3 of 4 of the CCM Big Four charts used in our models. This is stocks relative to the aggregate bond ETF. So you can look at this as risk on versus risk off. This is what a bearish look looks like. Bad things happen in the stock market. Bullish look with the ratio and the moving averages. Good things tend to happen. As of the close on Friday, June 7th, this still has a bullish look to it. Continuing with our weekly theme, this is risk on junk bonds relative to risk off or conservative treasuries. This is what a bearish look looks like with the ratio and the moving averages. Bad things tend to happen in the stock market. This is a bullish look for the moving averages and the ratio. Good things tend to happen. As we've noted in the past, this chart has a lower correlation relative to the 3 previous charts. It's helpful, but it's not as important when you're trying to track price for the S&P 500. The look of this as of the close on June 7th also rebounded intra-week. This looked ugly intra-week and finished the week with a bullish look. Now we're looking at a weekly chart of the NYSC Composite, another chart used in our models. Purpose of the exercise here, you don't want to put the cart before the horse. On a weekly chart, making decisions on Wednesday, June 5th, at least big decisions. What we do when a chart looks ugly intra-week, if our models tell us to move 10%, we cap it and say that we can only move a maximum of 5%. You do half in the middle of the week. The end of the week, you can always catch up if you're behind. If you move incrementally in these areas here, it lowers the probability of making a mistake intra-week. As you can see, as of the close on Wednesday, June 5th, this has a bearish look to it. Price below the moving averages, blue below red. The slopes of both moving averages turning down. This looks ugly. Notice on Wednesday, for the week, the NYSC Composite was down 1.33% as of the close on Wednesday, or 123 points. Let's fast forward to the close on Friday and see how this chart repaired itself. Same chart 2 days later as of the close on the 7th. Now we have blue back above red. This is no longer a bearish look. It's more of a neutral, still be careful look. You can argue that it looks similar to this point here, or even this point here, or this point here where gains did follow. This is not particularly a healthy looking chart, but it's not a bearish chart. It's a bullish to neutral chart as it sits as of the close on Friday the 7th. What it tells us is to err on the bullish side of the spectrum, but we should also respect that this chart still has some vulnerabilities. We would feel much, much better if this May high can be taken out. Even if we move back up near these highs on all these indices, we still have that Fed meeting to deal with. And it may make sense to take some profits off the table up here if we don't clearly break into a new high, if we make a lower high. It may also make sense to do some hedging if we make a lower high. We'll cross that bridge if and when we come to it. A lot of it depends on what the big picture looks like if we get back up into this region. If we clearly make a higher high, especially on a weekly closing basis or on a daily closing basis, the need to hedge or take profits off the table would diminish substantially from a probabilistic perspective. Sometimes in the stock market, simple things like trend lines, moving averages, and support and resistance can be powerful weapons. This is the weekly chart of risk on S&P 500 relative to risk off for the VIX. This chart is used in the CCM risk model. We covered this chart in detail in last week's video at the 2308 mark. You can review that if you want a little bit more detail on how we use this chart and what all this means here. The point of showing it again, one of the points made last week at the 2308 mark was that this acted as resistance here in the past, and we came across and we said it was possible that what once was resistance may now act as support. As you can see, the ratio appears to have bounced on cue at this potential support level. We also have potential resistance in the picture here. So if you're a stock market bull, you'd feel much, much better if this ratio can climb into this area here. This week turned out to be a week where having trend lines and charts in place and understanding retracement levels, etc., at least in the short run, look to be a good thing. If you go to our blog, Short Takes this week, we had several Be Patient charts listed. Here's June 5th. Some patience remains in order. Why? There was a potential support line coming here. If you move back up, it's the same chart. This is what it looked like on Wednesday. We did get the bounce where you would expect. It bounced here, and it bounced here, and the trend started here back in November of last year. As long as this chart stays in this region and doesn't move into this region here, that's a good sign. We also, during the pain and declines last week on the 5th, some patience is in order. We've got potential support in some of these areas. Some patience is in order. We've got potential support in some of these areas. We showed these fibs, said some patience is in order. We've got potential support in some of these areas. As it turns out, the low for the week was here at 1598, right in this area of fibs. This is a daily chart of the S&P 500 index used in the CCM risk model. These are fibs. This is the 50-day moving average. Stock market held near the 50-day. It's important to note it is not unusual to get a close or two or even three below the 50-day. Where you get concerned is when you get a close below the 50-day here and the slope of the 50-day starts to roll over. Here we ran into a bullish and upward sloping 50-day moving average, and you can see intraday on Thursday we dropped below it. As long as this slope is up, this is the 50, this is the 200, the benefit of the doubt longer term goes to the bulls. We had a 50-day moving average with a positive slope and Fibonacci retracement levels all in the same neighborhood. Nobody, including myself, knew whether this would hold or not, but it did make sense and still does make sense to show some patience as long as these fibs hold, as long as this slope is up, and as long as price remains above the 50-day moving average on the daily chart of the S&P 500 index. This is another chart used in the CCM risk model with the 50-day simple moving average and the 200-day simple moving average. You can see here we held at the 50-day. Nice bounce there. Williams percent R measures momentum. This is an oversold market. When you come out of oversold territory, typically good things happen. Out of oversold territory, typically good things happen. This week we appear to have moved out of oversold territory. Also, typically good things happen when you move out of oversold and then clear this negative 50. Clear the negative 50, good things happen. Clear the negative 50, good things happen. We closed above the center line or negative 50. All things being equal, as long as it holds above negative 50, good sign. We've covered this risk on, risk off chart several times in our videos. Another chart used in the CCM risk model. This is S&P 500 risk on relative to intermediate term treasuries risk off, or IEF, on a weekly basis. Point of the exercise here, this shows you this T where we closed. This is a new weekly closing high that was made this week. We exceeded this close, and this close. All things being equal, that's a good sign. We'd prefer to see this intra-week high taken out up here. Another point, it appears as if we went back and retested this blue moving average. Typically when you hold above the blue moving average, good things happen. Above the blue moving average, good things happen. Above the blue moving average, good things happen. It's possible with the Fed coming up that we come back and retest this trend line here in blue, or even this pink horizontal line here that acted as resistance in the past. We should just be aware that if we get weakness in the weeks ahead, there is potential support and relatively strong support in this range here relative to the longer term outlook. Quick point here, weekly small cap IWM still has a bullish and healthy look to it. This is what a bullish and healthy look looks like if you want to pause your video player. This is weekly risk off relative to risk on. We've tweeted this chart on Twitter numerous times. This is what a concerning look looks like for this ratio and moving averages. Concerning look here. Stock market corrects. You can see we were close to a concerning look. This chart looked ugly intra-week, but the close here favors bullish outcomes. Price has not cleared the moving averages. The blue moving average stayed below the red, and the slopes of both moving averages are turning over again, which seems to favor bullish outcomes. As long as this chart and every chart that we've looked at maintains its current look, the bias remains to the upside. We'll remain flexible and we'll keep an open mind, especially with a Fed meeting coming up and nonstop talk of Fed tapering. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.